Gold just suffered its worst single-day crash since 1983. Silver, down 27% in one day, the largest drop ever recorded. And this isn't just precious metals. Oil, copper, every major commodity, all bleeding red simultaneously. What triggered this multi-trillion dollar wipeout? And more importantly, what does this mean for your money right now? Stay with me because what happened on February 2nd, 2026 could reshape your financial future. And the next 25 minutes might be the most important investing lesson you'll get this year. Let me paint you the picture of what just happened in global markets. Monday, February 2nd, 2026. Singapore markets open, and within hours, commodities traders are watching their screens in disbelief. Here are the numbers, and these are not hypothetical. These are real, verified losses. Gold, down 9% to its lowest level in more than 2 weeks. This comes after hitting record highs just last week. Think about that. Record highs 1 week, massive crash the next. Silver, the white metal got absolutely demolished, falling more than 13% on Monday. But that's only part of the story. On Friday alone, silver plunged 27% in its largest daily decline on record. Let me repeat that, the largest daily decline on record. Oil dropped nearly 5.5%, pulling back from multi-month highs. Energy markets that were previously soaring suddenly reversed course. Copper, London Metal Exchange copper fell almost 5%. Industrial metals across the board took heavy hits. Other commodities, Tokyo rubber fell nearly 3%. Chicago wheat and soybeans both down about 1%. This wasn't a correction. This was coordinated carnage across every major commodity class simultaneously. Asian shares followed Wall Street futures deep into the red. The sell-off created what analysts are calling chaotic selling, the kind of panic-driven market behavior that signals something fundamental has shifted. So what caused this? What single event triggered billions of dollars to flee commodities markets in a matter of hours? The answer? One name: Kevin Warsh. On Friday, US President Donald Trump announced his choice for the next Federal Reserve chair. Kevin Warsh, a former Fed governor, was selected to succeed Jerome Powell as head of the US Central Bank starting in May. Now, if you're thinking that's just a personnel change, you're missing the bigger picture. The market's reaction tells you everything you need to know about what investors believe this appointment means. Vivek Dar, a commodities strategist at Commonwealth Bank of Australia, put it plainly. The decision by markets to sell precious metals alongside US equities suggests investors view Warsh as more hawkish. Let me break down what hawkish means in real terms. A hawkish Federal Reserve chair typically prioritizes fighting inflation over economic growth, is more likely to keep interest rates higher for longer, takes a stricter, more conservative approach to monetary policy, is less likely to print money or expand the Fed's balance sheet. Why does this matter for commodities? When interest rates are high, the opportunity cost of holding non-yielding assets like gold and silver increases. Money flows out of commodities and into bonds, savings accounts, and other interest-bearing investments. But there's another critical factor at play here: the US dollar. Dar also noted, a stronger US dollar is also adding pressure on precious metals and other commodities, including oil and base metals. Here's the mechanism. Commodities are priced in US dollars globally. When the dollar strengthens, commodities become more expensive for holders of other currencies, which reduces demand and pushes prices down. The Warsh appointment signaled to markets that the dollar would likely strengthen under his leadership, and markets didn't wait around to see if that prediction would come true. They sold first and asked questions later. The sell-off began Friday and accelerated through Monday as traders reassessed their positions in light of this new monetary policy reality. Now, if the Warsh appointment was the match that lit the fire, the CME Group threw gasoline on it. As selling accelerated in precious metals, the CME Group, which operates major commodities futures exchanges, announced they were hiking margin requirements on metal futures, effective from Monday's market close. For those unfamiliar with futures trading, let me explain what this means and why it matters. Margin requirements are the amount of capital traders must deposit to hold futures positions. Think of it as a security deposit. When the CME increases margin requirements, several things happen. First, traders suddenly need more capital to maintain the same positions. If you were trading gold futures with $10,000 in margin and requirements double, you now need $20,000 to hold that exact same position. Second, many traders don't have extra capital sitting around. This forces them to close positions, which means selling, to meet the new margin requirements. Third, the higher capital requirements discourage new speculative participation. Fewer buyers enter the market, reducing liquidity. Fourth, reduced liquidity makes price swings more volatile. When there are fewer buyers, even moderate selling pressure can cause dramatic price drops. This is exactly what happened on Monday. The CME announcement created a feedback loop. Prices drop, margin requirements increase, traders forced to sell, prices drop further, more margin calls, more forced selling, prices crater even more. This is what market analysts call accelerated selling, and it's why Monday's losses compounded on top of Friday's already historic declines. The timing couldn't have been worse. Markets were already reeling from the Warsh news, and the margin hike announcement poured fuel on an already raging fire. But wait, there's another critical factor in this story, and it's specifically affecting energy markets. US-Iran tensions. Going into last week, oil prices were at multi-month highs. Part of that was driven by fears of conflicts between the United States and Iran, a major OPEC member whose oil supply disruptions could send global energy prices skyrocketing. The Strait of Hormuz, controlled by Iran, is one of the world's most critical oil choke points. About one-fifth of global oil consumption passes through this narrow waterway. Any military conflict or blockade here would create an immediate energy crisis. Markets were pricing in this risk, pushing oil higher. Then came Trump's weekend comments. The president stated that Iran was seriously talking with Washington. Additionally, reports emerged that the naval forces of Iran's Revolutionary Guards had no plans for live-fire exercises in the Strait of Hormuz. Tony Sycamore, a market analyst at IG, identified these as clear signs of de-escalation. When geopolitical risk decreases, the fear premium built into oil prices evaporates quickly. That's exactly what happened on Monday. Oil prices, which had been elevated due to Iran tensions, dropped nearly 5.5% as traders reassessed the likelihood of supply disruptions. This is a crucial lesson in how commodities markets work. Prices reflect not just current supply and demand, but expected future conditions. When expectations change, especially rapidly, prices can move violently in either direction. The Iran de-escalation removed a key support holding up energy prices, and gravity took over. Now let's talk about the elephant in the room for industrial metals, China. Copper and iron ore markets faced significant headwinds from two China-specific factors. Factor 1. High inventories. Stockpiles of industrial metals have been building up. When inventories are high, it signals that supply exceeds current demand, which puts downward pressure on prices. Factor 2. The Lunar New Year. This month, China celebrates the Lunar New Year, which begins on February 15th. This is China's most important holiday, and it essentially shuts down significant portions of the economy for an extended period. In the run-up to this holiday, analysts noted that end-user demand and transactions are expected to be sluggish. Why? Because construction projects slow down or pause, manufacturing facilities scale back operations, workers return to their hometowns, business transactions decrease significantly. China is the world's biggest buyer of industrial and bulk metals. When Chinese demand softens, even temporarily, global commodities markets feel it immediately. Copper, often called Dr. Copper because of its reputation for diagnosing economic health, fell almost 5%. This decline reflects not just the immediate demand slowdown, but also concerns about China's broader economic momentum. The combination of high inventories and seasonal demand weakness created a perfect storm for industrial metals, adding another layer to the broader commodities sell-off. Section 6. The critical question. So here's where we need to pause and ask the most important question, the one that matters for your money. Is this the start of a structural downturn in commodity prices or merely a correction? This is the exact question posed by Vivek Da of Commonwealth Bank of Australia, and his answer might surprise you. We see it as a correction and a buying opportunity rather than a fundamental shift. Let me unpack what this means. A structural downturn would indicate that fundamental factors have changed in ways that will keep prices depressed for an extended period. This might include permanently reduced demand, major new supply sources coming online, technological shifts away from certain commodities, long-term economic contraction. A correction, on the other hand, is a temporary price adjustment that doesn't reflect change fundamentals. It's often driven by technical factors like margin requirements, short-term sentiment shifts, temporary risk-off behavior, position liquidation. Despite the severity of the sell-off, gold's worst day since 1983, silver's worst day ever, Da is maintaining his gold price forecast of $6,000 in the fourth quarter. That's significant. It means he believes the fundamental reasons to own gold haven't changed, despite this dramatic short-term price collapse. Think about what's still true. Global debt levels remain historically high. Inflation concerns haven't disappeared. Geopolitical tensions exist beyond just US-Iran relations. Central banks continue to hold and accumulate gold reserves. Fiat currency debasement concerns persist. These fundamentals didn't change on February 2nd. What changed was short-term market positioning and sentiment. Let me give you the practical, actionable insights you can use from this situation. Takeaway 1. Federal Reserve appointments have real immediate market impact. Don't dismiss political news as irrelevant to your investments. The choice of Fed chair can trigger multi-billion-dollar moves across asset classes. Pay attention to monetary policy signals. Takeaway 2. Margin requirements can accelerate market moves. If you trade futures or leverage products, understand that margin requirement changes can force liquidations at exactly the wrong time. This is why many professional traders maintain larger cash cushions than strictly required. Takeaway 3. Strong dollar equals pressure on commodities. This relationship is fundamental. When the dollar strengthens, commodities priced in dollars tend to weaken. Watch the dollar index if you're investing in commodities. Takeaway 4. Geopolitical risk premiums can evaporate quickly. Oil prices inflated by geopolitical fears can deflate just as rapidly when those fears ease. Don't chase prices driven primarily by fear. They are the most unstable. Takeaway 5. Seasonal factors matter in China-dependent commodities. If you're invested in industrial metals, mark the Lunar New Year on your calendar. It's a predictable period of demand weakness that savvy investors can anticipate. Takeaway 6. Distinguish corrections from structural changes. The severity of a price move doesn't automatically indicate fundamental change. Gold's 9% single-day drop was historic, but that doesn't mean the bull case for gold is broken. Takeaway 7. Market panics create opportunities. If you believe in the long-term fundamental case for commodities, dramatic sell-offs like this one can present buying opportunities, but only if you have sufficient cash reserves, a long-term time horizon, the emotional discipline to buy when others are panicking. Takeaway 8. Diversification still matters. Notice how commodities, stocks, and risk assets generally move together in this sell-off. True diversification requires thinking beyond traditional asset class categories. The commodities crash of February 2nd, 2026 will be studied for years to come. Gold's worst day since 1983. Silver's worst day ever. A coordinated sell-off across every major commodity class triggered by a single Fed chair appointment, amplified by margin requirement increases, and complicated by geopolitical and seasonal factors. But here's what you need to remember. Markets are cyclical. Panic creates opportunity, and the investors who understand why prices move, not just that they moved, are the ones positioned to profit when everyone else is frozen by fear. The question isn't whether another shock will come. It's whether you'll be prepared when it does. Stay informed, stay disciplined, And most importantly, stay rational when the market loses its mind.